Security analysis, company analysis. So in this session we will go through company's competitive edge, where we actually talk about variables from company analysis. We'll discuss a little bit on factors affecting future price of a company. We'll also see what are the factors affecting share value of a company, only briefly actually. So the investor during company analysis gets a hold of several pieces of information related to the company and then go on analyzing the company's stocks, present and future values. In order to take better investment decisions, the risk and return is closely studied as and when it gets associated itself with the purchase of stock. A pronounced set of company variables are also studied during valuation process, and depending upon how keen an investor is to deduce information from the company related variables, also from relationship and interrelationship that exists between these company related variables. So it can be stated without a doubt that for studying factors as it relates to the future stock price of a company, so factors affecting future price of a company, stock price of a company, the following are important, which are competitive edge earnings, capital structure, operating efficiency, management of a company, and financial performance of a company. Now, competitive edge earnings may be more like competitive advantage in financial terms. So that is what is competitive edge earnings, what the company has, how one particular company has an advantage over other companies in terms of management, a product, maybe a factor which affects a company, etc. Capital structure is basically based on debt equity ratio. Capital structure adjustments made to finance overall company operations and growth. So that is basically what is capital structure related factor which affects the stock price, future stock price of a company. Operating efficiency, it may reduce, it's basically operating efficiency in terms of reducing waste in time, effort and materials. So those are basically some of the operating efficiencies which are again factors affecting future share price of a company. Management of a company is there, and financial performance of a company also affects the future share price of a company. Now, some of the factors which affects share values of a company are historic price of stock, economic conditions, price earnings ratio and stock market conditions. Next, we'll take a look at, now let us discuss for the purpose of company analysis a certain set of variables and factors that are widely used in the accounting of performance of a company. So these are company variables that affects performance of a company. So first one is market share and annual sales. So in the industry landscape of India, big companies dictate or control the major market share. Only large companies can meet the competition successfully, especially when they achieve leadership position in the market. These competition between different companies in the market can be studied with the help of market share that a company assumes, as well as stability and growth of company's annual share. For a company that has a stable sales revenue, can have stable earnings and can afford wide variations in financial planning, capacity utilization and dividends. Quite often than not, we have seen in financial newspapers the market share of different companies in an industry, where a fall in market share for a company may indicate declining trend, even when the sales remain stable in all terms. Hence, it is important for the investors to study the trends regarding stability of sales in comparison to the competitive market share of other companies, as well as the market share of the company under study in all circumstances. So that is about market share and annual sales. Sales forecast. How it is a company variable affecting performance of a company. So the investor should have an idea whether the present day sales may well keep up with the trends and extend to future, and for that purpose, the investor must do a sales forecast action. So for that purpose, The investor may compare the macroeconomic variables like per capita income, gross domestic product, and population growth, as may fit a trend line, which may be linear or non-linear, whichever best suits. The investor can also study the demand for substitute products and use least square methods and techniques. The competitor products may also be analyzed that way. So that's about sales forecast. How about earnings of a company? For a company, the income is generated through operating sources and non-operating sources. In most cases, operating incomes for a company may emerge out of services rendered by the company. For example, in the case of commercial banks, the income is the interest on investments and loans provided, and hence the interest income is mostly operating income. But for the industrial sector, the income generated may be through sale of products that are tangible, and also there exists intangible sources that may be interest from bonds, rentals, dividends from securities. It also may be sale of assets, etc. Hence, the investor should analyze the income source and make sure whether the income is from investments or sale of assets. Also, sometimes the earnings per share for a company may be high on a particular year when the revenue generated through sales may be lower, and the reason for high earnings per share may be because of earnings through sale of assets. So it need not be through earnings, that is, it need not be through revenue generated through sales, but it may be because there is a sale of asset which happened in the company that the earnings are high. Hence, sales alone do not increase the earnings, since earning might be influenced by expenses and costs for a company. Also, earning might not increase with increase in sales and is due to rise in cost. So that is about earnings. About capital structure. The returns obtained for the owner of a company, in other words, the equity holder's return or income, is increased many times with the help of a proper financial leverage or a leverage ratio. That is to say, how adept, how quick the financial planners and managers do mix debt financing with equity financing, and how smart they are at it. So by computing leverage ratio, what is calculated is the effect of financial leverage on a firm. The debt ratio indicates position of short-term and long-term debts in matter of company finance. Mostly the debt a company accrues may be in the form of term loans and debentures, and obtained mostly from financial institutions. Next is preference shares. So how it is a company variable affecting performance of a company. So preference share capital is a significant source of capital these days. In fact, during current times, companies resort to preference shares. However, it needs to be noted that the leverage effect of preference share is lesser when compared to debt. That is mainly due to two reasons. So how it is leveraged? First reason is preference share dividends are not tax deductible, and hence if the share of preference share is in the capital is large, it tends to create instability in the earnings when the company earnings fluctuate. Secondly, sometimes preference share capital tend to be convertible preference share, and this may normally dilute the earnings per share, since when it gets converted, the shareholders increasing the share for a fixed earning. So these are the reasons why preference share, even though it's a significant source of capital, companies resort to preference share, but it needs to be noted the leverage effect of preference share. Lastly, it's debt. So debt, what is important source of financing is long-term debt. So it is the same as tax deductible. It is at a tax deductible, and the cost of capital for long-term debt is lower. The leverage effect of long-term debt is advantageous to the equity holders. During boom period, the positive side of leverage effect increases shareholder earnings, and during recession, the leverage effect indicates instability to the earnings, causing even bankruptcy. Hence, leverage effect of the debt needs to be studied also. So this covers a session on security analysis, in particular company analysis. Thanks.